This isn't just a dip in retail sales, it's a full-blown wipeout unfolding right in front of us. All over the US, brands that once seemed bulletproof are hemorrhaging money, shutting down thousands of locations, and discreetly lining up bankruptcy paperwork. Consumers are buried under $1.2 trillion in credit card debt. Foot traffic in malls is still down about 30%, and even bargain retailers are getting crushed as rent spikes, theft rises, and borrowing costs surge all at once. What you're about to hear isn't background noise or idle theorizing. It's a ticking clock. These aren't obscure or struggling labels. They're names everyone knows, and by 2026, a lot of them will simply be gone. Number 15. Foot Locker. At first glance, Foot Locker still looks like it's hanging in there, but once you dig into the numbers, the picture gets a lot bleaker. Over the past few years, the company has already said it will shut down more than 400 mall-based locations, and analysts believe that total could climb past 600 stores by 2026 if sales continue to slide. The root of the problem isn't complicated. Traditional malls are fading fast, and sneaker culture has largely shifted online. Digital-first brands and direct-to-consumer giants like Nike and Adidas now sell straight to shoppers, effectively cutting Foot Locker out of the equation and eliminating its role as the middleman. Financially, the decline is hard to ignore. Revenue topped out around $8.8 billion in 2022, but by 2024, it had fallen below $7.6 billion, while profit margins cratered, from over 6% to under 2%. In retail terms, that kind of squeeze is brutal. Rent, labor costs, and shrink from theft are all climbing, even as U.S. mall traffic remains roughly 25 to 30% below pre-2020 levels. In response, Foot Locker is pouring billions into store redesigns and high-profile urban flagship locations. The problem is timing. Those investments require serious capital at a moment when interest rates are still hovering around 5 to 6%, making debt far more expensive than it used to be. If consumer spending softens even a little in 2026, Foot Locker's razor-thin margins and shrinking store base could give way quickly. This is no longer a company on the rise. It's a business slowly pulling back, step by step. Number 14. Carter's sells a product families will always need, kids' clothing. But even that hasn't shielded the company from a relentless financial crunch. The real pressure starts with demographics. U.S. birth rates have dropped to roughly 1.62 births per woman, the lowest level in modern history. Fewer babies lead to fewer toddlers, which ultimately means fewer repeat purchases in the exact category Carter's relies on to survive. This isn't a short-term slump that bounces back. It's a demographic cliff. The company's revenue hit a high point near $3.9 billion in 2021, but by 2024 it had slid closer to $3.3 billion, while operating margins shrank from healthy double digits to barely 6%. At the same time, costs have surged across the board. Cotton prices are up more than 40% compared to pre-2020 levels. Labor has gotten more expensive, and shipping costs remain structurally elevated. Parents are also changing how they shop. Instead of paying for branded outfits, many are trading down to cheaper multi-packs from Amazon, Walmart, or Shein. Carter's has already responded by shutting down dozens of underperforming locations and openly warning about ongoing demand weakness. But store closures alone don't solve the deeper issue. When shrinking demand collides with rising costs, it creates a long-term margin trap. Carter's is carrying more than $1 billion in long-term liabilities, and refinancing that debt at 6 to 7% interest rather than the old 3% environment delivers a painful blow to cash flow. If consumer spending cools even modestly in 2026, this company could move quickly from under pressure to full-on restructuring mode. Number 13. Dollar Tree. Dollar Tree was once seen as the ultimate refuge in a retail meltdown. Ironically, it's now starting to look like one of the biggest casualties. The entire brand was built around a simple, powerful promise. Everything costs $1. That illusion shattered the moment Dollar Tree bumped its base price to $1.25, a 25% jump overnight. Shoppers noticed immediately. Traffic slowed, and the brand lost the psychological edge that once made it feel unbeatable. On the surface, revenue still looks impressive at north of $30 billion, but beneath that headline number, profitability is quietly eroding. Operating margins have slipped below 5%, down sharply from nearly 12% before the pandemic. Shrink from theft alone is now draining more than $1.2 billion a year, and management has openly acknowledged that thousands of locations are no longer meaningfully profitable. Then there's the baggage from Family Dollar. The $9 billion acquisition has turned into a major drag on performance, forcing hundreds of store closures and pulling overall results down with it. On top of that, Dollar Tree is carrying more than $10 billion in total debt, and servicing that load at today's higher interest rates is burning cash at the worst possible moment. Low-income shoppers, the company's core customer base, are already stretched thin, maxing out credit cards and cutting back even on small discretionary buys. When your customers are broke and your cost structure keeps inflating, the math deteriorates fast. Dollar Tree isn't a growth story anymore. It's a leverage trap disguised as a discount retailer. Number 12. JCPenney. JCPenney is the definition of a zombie retailer, technically alive but never truly revived. The company already went through bankruptcy in 2020, wiping out shareholders and eliminating thousands of jobs in the process. What followed wasn't a comeback, but a slow shuffle forward, propped up by private equity and borrowed time. The footprint alone tells the story. At its peak in 2012, JCPenney operated more than 1,100 stores. Today, that number has shrunk to roughly 650, with additional closures already built into the roadmap. Sales paint an even starker picture. A decade ago, revenue topped $17 billion. By 2024, the company struggled to maintain $7 billion, less than half of what it once generated. The real anchor dragging the business down is real estate. JCPenney is still saddled with billions in lease commitments and long-term liabilities tied to aging malls that shoppers increasingly avoid. U.S. mall traffic remains 25 to 35% below pre-pandemic levels, and former anchor tenants like JCPenney no longer draw crowds, they repel them. Its customer base is getting older, brand relevance continues to fade, and private label apparel is under relentless price pressure from Walmart, Amazon, and ultra-cheap fast fashion players. With interest rates elevated and refinancing options drying up, the company has virtually no room left to stumble. If the economy weakens in 2026, this won't be framed as a failed turnaround. It'll be remembered as a liquidation that everyone saw coming. Number 11. Kroger. At first glance, Kroger doesn't scream trouble. It's the largest grocery chain in the country, hauling in more than $148 billion a year in revenue. But sheer size doesn't save you when margins are razor thin and expenses keep piling up. Grocery is a low-profit business by nature, and Kroger's net margin hovers around 1 to 2%. At that level, even a small disruption, higher wages, lighter store traffic, or a sudden price war can wipe out billions in profit almost instantly. Labor is one of the biggest pressure points. Kroger employs over 400,000 workers, and union agreements are steadily pushing wages higher. At the same time, grocery inflation is cooling, which limits the company's ability to raise prices and protect margins. Theft has also surged, especially in urban locations, draining hundreds of millions of dollars each year from the business. Then there's e-commerce. Online grocery fulfillment still struggles to make money, even as Amazon and Walmart burn cash to dominate the space. Kroger is stuck competing in that same arena while carrying heavy leverage from past acquisitions and investments. Total debt now sits close to $20 billion, and refinancing that balance at 6% or higher, instead of the old 3% environment, delivers a serious blow to free cash flow. Layer on slowing consumer spending, reduced SNAP benefits, and more shoppers trading down to Aldi and Costco, and Kroger's reputation as a safe defensive stock starts to crack. In a 2026 downturn, this isn't a picture of stability. It's a pressure cooker waiting to blow. Number 10. Walgreens. Walgreens is coming apart slowly, and most people don't even realize it's happening. The company has already revealed plans to shut down more than 1,200 U.S. locations by 2027, marking one of the most aggressive retail pullbacks in recent history. On paper, revenue still looks enormous, hovering around $140 billion. But that headline figure hides a much uglier reality underneath. Profitability has essentially evaporated. Operating margins have dropped below 2%, and in several quarters, Walgreens has been skating right on the edge of break-even. The core pharmacy business itself is structurally broken. Insurance companies and government programs continue to slash reimbursement rates, while wages for pharmacists and technicians keep climbing year after year. In an attempt to escape that trap, Walgreens poured over $6 billion into healthcare clinics and primary care services. Much of that bet has already gone bad, with large portions written down after failing to deliver meaningful returns. Meanwhile, retail theft has exploded, costing the company well over $1 billion annually and turning thousands of stores into cash drains rather than profit centers. The balance sheet only makes matters worse. Walgreens is burdened with more than $35 billion in total debt and lease obligations, and refinancing that load at 5 to 6% interest rates is hammering earnings. Foot traffic keeps sliding, front-end retail sales are soft, and shoppers are pulling back on discretionary items like cosmetics and convenience purchases. Number 9. Bargain Hunt. Bargain Hunt is the kind of retailer that doesn't go out with a bang. It just fades away. No breaking news alerts, no national outrage, just dark storefronts and liquidation banners taped to the windows. At its peak, the closeout chain ran more than 90 stores across the Midwest and South, offering surplus and overstock merchandise at steep discounts. But the model only works if two very fragile conditions hold. First, other retailers need to be drowning in excess inventory. Second, shoppers need enough spare cash to impulse buy cheap decor and random gadgets. Right now, both of those assumptions are falling apart. After filing for bankruptcy, Bargain Hunt moved quickly to liquidate nearly all of its remaining locations. The reasons were blunt and unavoidable: rent that no longer made sense, foot traffic that had collapsed, and supply chain costs that never truly came back down. Revenue reportedly dropped over 40% in less than 2 years, while operating losses piled up into the tens of millions of dollars. Even cheap retail isn't cheap anymore. Freight costs are still 30 to 50% higher than pre-2020 levels, and commercial rents never fully reset. But the biggest blow is coming from consumers themselves. Low-income shoppers aren't bargain hunting for home decor or novelty items anymore. They're spending what they have on food, rent, utilities, and debt payments. When survival replaces browsing, stores like Bargain Hunt vanish fast. By 2026, this chain isn't mounting a comeback. It's a warning shot, a glimpse of what's likely ahead for dozens of smaller U.S. discount retailers next. Number 8. Claire's. Claire's looks innocent enough at first glance. Bright storefronts, cheap accessories, and a heavy dose of teenage nostalgia. But financially, it's a mess that never actually stopped unraveling. The company already went through bankruptcy back in 2018, wiping out equity holders and restructuring billions in debt. That wasn't a true comeback. It was a temporary pause on the collapse. Fast forward to today, and the pressure is still there. Claire's is carrying more than $1.5 billion in long-term debt and lease obligations, most of it tied to struggling malls that have lost 25 to 35% of foot traffic compared to pre-2020 levels. Meanwhile, its core audience, teens and preteens, has largely moved online. Platforms like TikTok Shop, Shine, Temu, and Amazon now dominate impulse fashion, offering prices and convenience Claire's simply can't match. Shrink theft has also surged across mall locations, quietly erasing millions of dollars in inventory every year. Revenue hasn't just softened, it's been steadily declining, with estimates showing sales down more than 20% from pre-pandemic levels. The business model itself no longer works. Most products sell for under $10, but rent, labor, and security costs have jumped 30 to 50% since 2019. That math breaks fast. Even small drops in traffic now push many stores into negative cash flow territory. Without major debt forgiveness or aggressive store closures, Claire's isn't staging a revival. It's a slow liquidation, just wrapped in neon lights and pop music. Number 7. Big Lots. Big Lots has gone from looking like a discount store survivor to landing squarely on the bankruptcy watch list, and it happened fast. Not long ago, the chain operated more than 1,400 stores across the U.S. Now, it has already announced hundreds of closures, and cash is burning at an alarming rate. The financial slide is unmistakable. Revenue peaked around $6.1 billion in 2021, but by 2024 it had fallen below $4.7 billion, while losses ballooned into the hundreds of millions. This isn't just about softer demand. The deeper issues are inventory mistakes, shrinking margins, and a consumer that's growing more cautious by the month. Big Lots leans heavily on furniture and home decor, exactly the categories shoppers abandon first when money gets tight. With average household credit card balances now over $10,500, consumers aren't shopping for sofas. They're prioritizing groceries, fuel, and basic necessities. Debt tightens the vice even further. Big Lots is carrying more than $1 billion in total liabilities, and refinancing that burden at 6 to 8% interest is crushing free cash flow. At the same time, rent, utilities, and theft-related losses have surged, while aggressive clearance markdowns are gutting already thin margins. Even deep discounts aren't clearing inventory fast enough to stabilize the business. If a recession hits in 2026, Big Lots doesn't have the balance sheet to absorb the blow. This isn't a company in turnaround mode. It's in the final stages of unwinding. Number 6. Macy's. Macy's isn't collapsing in dramatic fashion. It's slowly contracting, and that kind of decline is often more dangerous. The company has already said it will shutter more than 150 additional stores by 2027, on top of the 400-plus locations it's closed since 2015. That leaves the chain with roughly 750 stores today, and even that number is unlikely to hold as mall traffic continues its long slide. The revenue trend tells a much harsher story than the headlines suggest. Back in 2014, Macy's generated over $28 billion in sales. By 2024, revenue had fallen closer to $23 billion, and that's before adjusting for inflation. In real terms, the decline is far steeper than it appears on paper. Margins have been squeezed down to under 4%, while shrink from theft alone is now costing an estimated $1.2 billion every year. Debt adds another layer of pressure. Macy's is carrying more than $10 billion in long-term debt and obligations, and servicing that balance in a 5 to 6% interest rate environment drains cash that once went towards store upgrades, innovation, and share buybacks. The customer base is also shifting in the wrong direction. Shoppers are getting older, private label brands are losing their pull, and online fast fashion competitors are undercutting prices by 30 to 60%. By 2026, Macy's won't just be dealing with a tough retail cycle. It'll be confronting the slow death of the department store model itself, without the financial armor needed to emerge unscathed. Number 5. Saks Global. Saks Global is a case study in what happens when high-end retail runs headfirst into the hard limits of debt. The company was formed by combining Saks Fifth Avenue and Neiman Marcus into a single operation with the promise of scale and stability. Instead, the merger produced one of the most heavily leveraged department store structures in the country. Today, the combined debt and long-term obligations sit north of $9 billion, a massive burden in an environment where luxury mall traffic is still 20 to 25% below pre-2020 levels. And while luxury shoppers were once thought to be insulated from downturns, that assumption no longer holds. With credit card balances topping $1.2 trillion and mortgage costs climbing, even high-income households are starting to pull back. At the same time, Saks Global's core customer is drifting online. Platforms like Farfetch, Net-a-Porter, and direct-to-brand websites are winning on price, loyalty perks, and delivery speed. That leaves Saks stuck with premium mall rents while competing against digital-first rivals that operate with dramatically lower overhead. Margins are already thin, and the pressure is showing up in inventory. Markdowns are increasing, and in 2024 alone, the company reportedly wrote down hundreds of millions of dollars in unsold merchandise as demand softened. On top of that, refinancing debt at 6 to 7% interest, instead of the old 3% era, is rapidly draining cash. Number 4. GameStop. GameStop is a company that, by all normal rules, should already be gone. The meme stock frenzy didn't rescue it. It merely pushed the inevitable further down the road. Since 2017, the retailer has shut down more than 1,000 stores, cutting its physical footprint by over 40%, and additional closures are still on the way. The core problem is structural and irreversible. Physical video game sales are imploding as digital downloads now make up more than 85% of all US game purchases. That single shift completely erases the business model GameStop was built on. The financial decline reflects that reality. Revenue peaked around $9.2 billion in 2012, but by 2024, sales were barely holding above $5 billion, even after aggressive cost-cutting. Attempts to reinvent the company have gone nowhere. The push into NFTs, e-commerce gadgets, and collectibles burned through hundreds of millions of dollars while delivering almost nothing in return. Operating income remains weak, same-store sales continue to slide, and customer traffic keeps thinning out. Yes, GameStop is sitting on roughly $1 billion in cash, but that isn't a growth strategy, it's a ticking clock. With declining relevance, shrinking foot traffic, and no credible long-term plan, that cash is far more likely to bankroll ongoing losses than spark real innovation. By 2026, GameStop probably won't go out in a dramatic bankruptcy filing. Instead, it will fade away slowly, store by store, until the brand is remembered as just another relic of the mall era. Number 3. Rite Aid. Rite Aid is already gone in every way that matters except the logo on the building. The company has filed for Chapter 11 bankruptcy, shut down hundreds of stores, and is now being dismantled piece by piece. At its height, Rite Aid operated more than 4,600 locations nationwide. Today, fewer than 1,700 stores remain, and that count continues to drop at a rapid pace. The financial implosion has been severe. Before bankruptcy, Rite Aid was carrying over $8 billion in debt, while annual revenue slid below $24 billion, down from more than $26 billion just a few years earlier. Operating losses piled up into the hundreds of millions, leaving the company with almost no financial flexibility. Then came the knockout blow: opioid-related lawsuits, which alone drained billions of dollars and erased any realistic path to recovery. Beyond the legal damage, the core pharmacy business is fundamentally broken. Reimbursement rates from insurers and government programs keep shrinking, while wages for pharmacists and technicians continue to climb. At the same time, theft, security, and regulatory compliance costs are surging, pushing thousands of locations into negative cash flow. Rite Aid isn't a comeback story anymore. What's happening now is a public liquidation, playing out in slow motion. By 2026, whatever is left of this brand will likely be sold off in pieces or quietly shut down altogether. This isn't just another retail failure, it's a full extinction. Number 2. Joann is a textbook case of how a once reliable niche retailer gets squeezed from every direction at once: debt, digital competitors, and collapsing discretionary spending. The fabric and crafts chain filed for Chapter 11 bankruptcy in 2024, weighed down by more than $1.6 billion in total liabilities. That filing wasn't a bold reinvention. It was a last-ditch move to stay alive. Since then, the company has been in retreat. Hundreds of stores have been shuttered, inventory has been cut back sharply, and management has openly warned investors that there is substantial doubt about Joann's ability to continue operating. The revenue trend explains why. In 2019, the company generated over $2.7 billion in sales. By 2024, that figure had fallen closer to $2.1 billion, and that's before factoring in inflation. In real terms, the decline is far steeper than the raw numbers suggest. Costs, meanwhile, refuse to cooperate. Freight expenses remain 30 to 50% higher than pre-2020 levels. Labor costs are up double digits, and shrink from theft is climbing across suburban strip mall locations. Every line item is moving in the wrong direction at once. The customer base is under stress too. Hobbyists and DIY crafters are easy to lose when household budgets get tight. When rent, groceries, and utilities consume most of a paycheck, yarn, fabric, and scrapbook supplies are the first things to go. Even after restructuring, Joann is still carrying over $900 million in long-term debt, and refinancing that balance at 6 to 8% interest is draining cash at an accelerating pace as 2026 approaches. This isn't a turnaround in progress, it's a liquidation timeline, and the ending is painfully familiar. Number 1. Forever 21. Forever 21 isn't merely having a rough stretch. It's been unraveling in slow motion for more than a decade. The fast fashion giant filed for bankruptcy in 2019, shut down over 800 stores worldwide, and emerged as a much smaller, far more fragile version of its former self. Today, its U.S. presence has dwindled to around 400 locations, and that footprint continues to shrink as mall leases expire and losses keep stacking up. The revenue collapse tells the story clearly. At its peak, Forever 21 generated more than $4.4 billion annually. By 2024, estimates put U.S. sales closer to $1.6 to $2.0 billion, a devastating decline that looks even worse once inflation is factored in. But shrinking sales aren't the core problem. Competition is. Ultra-fast online brands like Shein, Temu, and similar players now sell nearly identical styles for 30 to 60% less, with faster shipping and virtually unlimited selection. Forever 21 simply can't compete on price while still paying mall rent, utilities, labor, and security costs tied to physical stores. The balance sheet only deepens the strain. The company is weighed down by hundreds of millions of dollars in lease obligations and supplier debt, while shrink from theft continues to rise. Inventory markdowns are constant just to keep products moving, and U.S. mall foot traffic remains 25 to 35% below pre-2020 levels. By 2026, this won't be framed as a comeback attempt. Forever 21 is drifting toward a second bankruptcy. This time, there won't be a redemption storyline, just liquidation signs and vacant storefronts marking where a retail empire once stood.